Alright folks, today we're going to be doing a video about how I invest, and specifically I'm going to be talking a little bit about free cash flows and how they influence my investment decisions and how I kind of like interpret and analyze them. And we're also going to be looking a little bit at equity, shareholder equity, specifically negative shareholder equity. We will be looking at a couple of live examples up on the screen here. We've got Lowe's. That's that home kind of like hardware store, whatever they call them. So let's just dive right into that. But before we do, let's just take a quick look at earnings.cc. I get a lot of good info from here. This site's always updating. It's always reading off the SEC Edgar database. And anytime a company in the US reports earnings related stuff, it generally shows up here. And it shows up within low single digit minutes of being posted to the SEC. So what exactly is free cash flow? Free cash flow is a bit of a moniker that people have assigned to a condition that occurs when your operating cash flow, or your cash from operations, exceeds the quantity of money that you invested into existing or future operations. So what does that mean? Well, let's say I have an automotive shop, and I do oil changes, and so I have those pits, and I have that jack, and I have 4 of them, right? And let's just say that every year, or every jack is expected to last 4 years, right? So I've staggered my purchases, and so one of them is set to expire every year after it's achieved its 4-year lifespan, okay? So I have my regular expenditures for operations. So that's like the cost of my oil that I use to change the oil out in the cars that pull up. It's the cost of my labor, the guy that's in the pit, and the guy that lifts the hood, and the guy behind the till, right? Or it doesn't have to be a guy. So those are my operating costs. But every year I expect to have to purchase a new lift, a new jack, right? 1 out of 4. Now those are capital expenditures. That's an investment into my operation for the future, okay? Let's say one of them breaks and I have to replace it at the 2.5-year mark. That's an investment into my current operation, okay? So those are investments into your operation. Those are assets that last more than one period, right? So you have to depreciate them over time. Now that makes them assets as opposed to expenses, and so these are the type of cash outlays that, if they amount to a quantity that is less than your cash from operations, then you have positive free cash flow. So let's just see what that looks like in an actual kind of like financial breakdown here. So you go to your balance sheet. No, wait, you go to your cash flow statement, sorry. And basically we're looking for this number to be greater than this number. So here they've knocked off 2 billion off of 10 billion, so their free cash flow is 8 billion, positive 8 billion. So that's a really high level. If you break it down a little bit more, you get something called capital expenditures, right? Because they have other stuff, like there could be a million other things here. You have to really focus on the capex stuff. Capex. Now you can focus even more. See, net business purchases. So this is them investing in another business. So that's a form of capex. That's adding a new operation, right? Net PPE, that's PPE is property, plant, and equipment. So that's physical stuff. So for a company like Lowe's, that might be new stores, new warehouses, new distribution centers, new land. But the one that you got to watch out for is net investment purchases, because that might just be like commercial paper, interest-bearing products. It could be stock. It could be they had a bunch of cash and they decided to buy a bunch of Home Depot stock. I don't know. Let's hope they didn't buy Boeing. I don't know. So you can break it down further, but if you want a really high-level, easy way to calculate free cash flow, you can just take cash from operations less whatever they spent on cash from investing, and that's loosely your free cash flow, okay? So what do I look for when I look at good companies? Now, what's a good company? For me, a good company is a company that I can reasonably expect to have a lot of growth. Growth pays off in the long term, A, because it compounds, B, because it gives you an opportunity to compound its fruits, and C, the fruits. So what are the fruits? The fruits of growth are capital gains, dividend distributions, share buybacks, reduction in liabilities owed. All of these things add value to the share price. And all of these things are facilitated by available free cash flows. Okay, without free cash flows, none of these things occur. So free cash flow must be present. Sorry, let me take that back. Cash from operations, operating cash flow, must be present and healthy. It doesn't necessarily have to translate into free cash flow as long as you can identify that it's going into something productive, like investments into the future, capex, right? You can have reduced free cash flow if that cash is moving into something that's either going to be or is productive, a capital investment of some kind. Now, let's look at some data. Again, we've got Lowe's up here. We all know what happened in 2020. We all know that companies like Lowe's and Home Depot had windfall profits. So when you're looking at companies that demonstrate strong earnings growth, you really want to see that they're backed up with free cash flow. So for example, here, or at least operating cash flow, right? Remember what I said. Here we can see the diluted EPS against the share price, right? So there was really only one quarter where they reported a negative EPS, this diluted, but you can see that they're all positive, right? Now, if we jump over to the free cash flow figures, you can see there are a few more quarters that are negative, but we also know that they might have spent money investing, right? So that's not bad, but in general, they're all positive and they generally correlate nicely to the earnings, right? You know what I mean? Let's just open up another window here and take a look at the operating cash flows. Come on, yeah, let's check out this one. There we go, financials, balance sheet. No, cash flow from operation. Yeah, there we go. See, a few negative quarters, 3, I believe, 4. But in general, the positivity of the operating cash flows from operation, loosely and generally matches the earnings. This is what you want to see, folks. If you start to see earnings that are missing cash flows, these are hollow companies. You don't want to buy into them, at least not if you're looking for growth. Let's look at another example. Oh, before we do that, let's just look at something else that I'd like to point out. Lowe's is interesting because this is the shareholders' equity. So equity is assets less liabilities, right? It's the book value of the company. Now, this is the zero line, folks. So basically from here forward, okay? So from Q1, in between Q1 and Q2 2021, Lowe's went equity negative. So negative book value. So their company's underwater. Does that mean they're bad? No. Look at the growth. I mean, from 120 to 280. So more than double. 150% growth in 3 years, 4 years, whatever. While they're demonstrating negative equity. So I wanted to use this as an example where a metric that would generally indicate that a company is a failure can be grossly, egregiously negative, and the company can still be hitting it out of the ballpark. And the indicator that you need to look for are healthy earnings backed by healthy cash flows, folks. So I'm showing you how you can analyze and interpret the cash flows of a company, match them against their earnings, and then measure the growth that you're seeing, right? Because ultimately you still have to see growth, and you'll see that if you start doing these calculations, you'll recognize whether or not there's growth. See, from 8.1 to 9.8, right? From 8.5 to 9.8. See, there's growth. Okay. Let's check out another example. Let's take a look at McDonald's. McDonald's. Let's take a look at their balance sheet real quick and see. Let's take a look at their equity. Ooh, see how it's all negative? Okay, let's look at their income statement. Okay, so they've got like revenue in the mid-20s. Diluted net income, so about 30% net income. Let's check out their cash flows. Let's just drag this out a bit. See, free cash flows very similar, slightly under their reported incomes, right? See, their reported incomes right here. So maybe $1 to $2 billion under. I wonder why. Maybe because they're investing in more land always to plant down more McDonald pad restaurants. Oh, that's the financing. PPE. Okay, so very limited real stuff. Business purchases. A lot of business purchases, but not that much going back. Other investments. Yeah, I mean, whatever, right? Just random stuff. So these guys are showing really healthy free cash flows relative to their reported incomes. Let's just see what that looks like on the graphs. And folks, I hope you're enjoying this video, and if you are, please hit the like and subscribe buttons. I really need the... Alright folks, I got cut off there. So again, just please hit the like and subscribe button and watch my videos if you're getting any juice out of this. They're only going to get better. I'm working on tools. I'm working on a portfolio that I'm going to be sharing, and it's going to be a growth portfolio. It will do well. Watch my videos. Anyways, this McDonald's. So this is showing the cash from operations, folks. So this is the zero line right here, okay? So there's only one negative quarter, the first quarter of 2020. We all know what happened then. Dang, TradingView. I'm not going to pay you, I'm going to replace you. Keep watching my videos, you'll see. Anyways, you can see the healthy cash from operations, right? And you can see that they mimic the earnings. This is diluted EPS. So like the zero line doesn't even show up here, folks. The very bottom is the 50-cent mark. Again, this diluted EPS. But generally, you see healthy, upward, strong earnings being reflected in the operating cash, okay? Cash from operations. Now here we have the free cash flows. Here's my zero mark. Again, we just have one negative quarter. We had a low quarter here, but again, that could have been CapEx, right? Let's take a look at so the operating cash was also low. Okay. Same with the earnings. Okay, see how they all reflect each other? That's healthy. That means nothing's being obfuscated. That means the operations are transparent, right? So what do we have here? Again, McDonald's chronic net negative equity, folks. This is the shareholders' equity. Again, the zero line doesn't even show up here. The highest ones are negative $2 billion in shareholder equity. See, we go to the balance sheet. Tangible book value. Look, negative 10, negative 7, negative 8, negative 7. Right? We go to the shareholders' equity. Negative 7, negative 4, negative 6. See, so these are McDonald's is a corporation that has negative book value. If they were to cease operations, they wouldn't have the money to pay off what they owe. They're so profitable though that nobody cares. Everybody knows that they're going to make so much cash in the next period that it's irrelevant that they owe more money than they have assets. Okay? And you can see it right here, right? Because the highest value is negative $2 billion. And zoom, right? So it's chronically negative equity. But look at the growth, right? And the reason that I've decided to show this in this free cash flow example is because that sort of opposing relationship where it's okay to have a really negative metric like negative equity as long as you're generating really healthy cash flows, right? You have to find these accounting relationships and learn how they relate to each other and what they can tell you. So in this case, in a case like McDonald's and Lowe's, the negative equity is not a negative reflection. In fact, it's the exact opposite. It's a reflection that those companies are so strong, they have so much cash coming in that creditors are willing to lend them more than they have to their name. Think about that. Now, how does that relate to cash flow though? It's because you see the same relationship only with a different sign in the free cash flow or operating cash flows to the net incomes, right? The earnings. If you don't see symmetry and you don't understand why, that's a red flag, folks. You want to see symmetry between, at the very least, operating cash flows and earnings, but hopefully free cash flows as well. And if you're not seeing free cash flows, folks, just walk away. That's the biggest red sign of them all. Unless you're a huge, high growth company that probably is getting a lot of attention. And an example is Amazon, right? How long did they have to continue reinvesting? They didn't have to, they chose to. And look at how much it paid off, right? So those are really outlier cases though. Let's see if we can find one that's kind of lame. Let's look at Boeing. Let's look at Boeing, folks. What is it, B? No, what was it? Boeing? BA. I wonder what Boeing Aeronautics, maybe? I don't know, whatever, folks. Okay, let's see. BA Baracus from the A-Team, Mr. T. If anybody here knows who Mr. T is or knows who BA Baracus is, I want to see that in the comments. Let's start with our income, No, that's a free cash flow. Okay, so EPS, diluted EPS. So I used to like Boeing, folks, and this is the 2020 mark, by the way, right here. This is 2020. I remember in December of 2019 telling someone how great Boeing was. So for the record, that's this bar right here. And I was like, oh yeah, Boeing, they're not doing so great right now, but they're a stand-up company that you'll see they're a cash cow. And we all know how that went. So the zero line is right here. Again, this diluted EPS, right? So mostly since 2020, it's been in decline since, it's been below water, right? Even since 2019, okay? What's this? Ah, come on, man. Okay, what's this? Okay, so here we have free cash. Where's my freaking operations? Okay, cash from operations here. See, here's the zero. So in general, we also see the negative cash from operations, right? So again, it's mimicking the earnings. So I'm just showing you this so that you can see that it's the same in a company that's struggling. We do have a few positive operating cash flow quarters. Let's see how that translates to the earnings. Close the connection, come on. So that's like these ones here, and folks, they're just at zero. Like maybe there might have been one or two slightly positive. What's this one? So do we have our free cash flow? Again, we've got free cash flow in these quarters reflecting the same as the operating cash flows, but in general we're seeing negativity here. So earnings and cash flows, they should go hand in hand. If they don't, you need to understand why. Otherwise you're not doing your job as an investor. And of course their shareholders equity has just collapsed, right? They were plus minus like in the high teen years prior to 2020, and then they just collapsed. In this case, it is a reflection of negativity, right? It's a reflection of the erosion that negative operating earnings and free cash flow will do to you. Anyways, I hope you guys enjoyed this video and stay tuned for more.